So, in this lecture, I want to, as best as I can, try to update everyone and as well wrap my own head around the nature of the financial and economic situation as it exists now on March the 23rd. So, my knowledge is not perfect by any means, but this gives you at least a kind of a base understanding that we can then all work with. So I made these slides myself, so keep that in mind. So let's start first with this idea of what were we coming into this current situation with? Before I actually talk about what the current situation actually looks like. So let's start with this. And I guess we'll watch this 14-second commercial beforehand. Sorry, there's nothing I can do here.
Make trading quicker and simpler so you can take on the markets with confidence. Don't get mad. Get E-Trade.
We'll see you more later this hour. The four major averages trading higher by 22%.
So this is from CNBC, and this is from the start of January of 2020. Now, keep in mind, hindsight's 2020, so don't look back at this and think this guy's really dumb or something like that. Just keep in mind that this is what the sentiment was at the beginning of the year. So this is from early January of 2020.
Or more this year, but despite the rally, our next guest says risks of a recession next year remain elevated. Joining us now with his 2020 outlook is David Rosenberg, president of Rosenberg Research. David, great to have you on. We've been hearing this narrative in recent weeks, and we've heard that this is really what's powering the markets higher right now, that we're seeing the slowdown in global economic growth bottom, stabilize, poised for renewed strength in 2020. Why do you think there's still elevated risks of recession?
Well, actually, when you're taking a look at official recession risk models, they're at the same level today that they were at 12 months ago when the stock market was 30% lower than it is today. And it's interesting that nobody talks about the fact that, we got the Conference Board's leading economic index a few weeks ago for November. The consensus that it was supposed to go up, it was flat, and it's actually been flatter down the past 7 months. So what I tend to find is that a lot of economists...
So as you're looking at this here, what he's basically talking about is 2019 was such a hot year, and you can kind of see in the corner here, right, that throughout 2019, the markets were up 1/3. This is looking at Standard & Poor's. The other one was looking at Dow Jones. When he's talking about a recession here, or not a recession, but basically that things were growing so hot, so fast that it was bound to cool down just a little bit only because it was growing so fast. That's basically his argument. I'll let him still argue the rest of it, but that's essentially what he's arguing here.
The strategists will look at the price action in the stock market or risk assets, and then they'll fit the narrative to the price action instead of actually explaining what's really going on out there. Now, we can talk about the full year if you want to talk about the full year, but here's the reality. The reality is that as of October the 8th, the 12-month return in the Wilshire 5000 index was 1.2%. And on October the 8th, the 12-month total return in the 30-year Treasury was plus 30%. So this has nothing to do with anything except what happened in the first couple of weeks of October, which two things happened that caused this major inflection point, which was phase one talk out of Donald Trump, and that created a lot of positive sentiment and momentum. And that's when the Fed issued its memorandum saying that they were going to start to hoover up the Treasury bill market, not saying it's actually QE4 when it actually is QE4, but that liquidity injection that's ongoing has caused the money supply numbers to go gangbusters at a time when...
So I want to pause that right there. So what he's saying right here, which we're going to see here is going to become a little bit more problematic, is that he's saying that at the end of 2019, you can see here this title here, Fed Rate Hikes and Cuts. That basically in the beginning of, I guess just let me play it here a little
Business
bit.
credit's actually contracting, which is interesting because that excess liquidity hasn't found its home in the real economy. It's found it.
Okay, so you can see here, and then I'll unpause it here. You can see that throughout 2018, what this is saying here is 25 BPS basis points. That means that the interest rate is going up for the Federal Reserve. If the interest rate's going up, that means that they're trying to slow slow the growth of money, which is basically a way to try to cool down the economy. So this is 2018.
Its way into risk assets. By the way, not just the equity market, but look at what credit markets have done.
And so then you can see here in 2019, it's the reverse, that they then reduce it by basically 0.75% throughout 2019 in an attempt to stimulate the economy. So they're stimulating the economy, bringing down the interest rate, even though in 2018 they had done a lot of work to raise the interest rate.
Commodity markets have done. So in the past 3 months, we've had this real sudden liquidity-infused run-up in risk assets writ large. Nothing at all.
So what he's saying right there is, because the Federal Reserve did what it did in 2019, especially at the end of 2019, that the stock market went up significantly faster at the end of 2019 because of what the Federal Reserve had done.
I'll do with the fundamentals despite what the gurus are telling you.
Okay, so now where things then start to get a little bit scary is when you start looking at things like what Goldman Sachs, one of the large investment banks in the US, then basically says, is that at the beginning of 2020, they were saying that basically no recession will ever happen in the US. But as we know now, and we'll discuss here in a few slides, we kind of already know now that a recession has probably begun. That report, that Goldman Sachs report called The Great Moderation, said that basically we didn't have a lot of volatility, growth was sustainable, and there wasn't a lot of inflation. So this is the quote. Overall, the changes underlying the Great Moderation appear intact, and we see the economy structurally less recession-prone today. So I don't know if they're saying like recessions will never happen, but it's highly, highly unlikely that they will. And basically the only thing they could say was that after growing really, really strongly for 11 years, that basically the only thing that would happen is that we would have a soft landing, meaning that the economy would kind of slowly slow down. It wouldn't necessarily decrease, but it would increase at a much slower rate. And that there were no kind of sources of a recession like an oil shock, inflationary overheating, financial imbalances that they saw as causing it. Although what they do say here, and it should be noted, that what they do say here is that new risks could emerge. Obviously, one of those risks would be COVID-19. And you see this here. An unknown international shock. Now, at the time, most people were worried about, if you kind of remember way back in the time, this is when like we were bombing parts of Iran, and some of the things going on there. So everyone seemed to be worried about more about international events in that kind of sense, not international events in that there was a international pandemic. So here's the question. Are we going to have a recession? Well, we can't say that we do yet. There's a traditional definition of a recession that some of you may remember back to when you took Econ 131, which is that the GDP falls by 2 quarters, decreases 2 quarters in a row. Now, that's not exactly the definition. It's kind of a quick-handed definition, but recessions actually are dated by the National Bureau of Economic Research. And a committee basically gets together and they decide when recessions start and when they end. Now, Let's just go back here. Sorry, I don't want to look at the whole thing here. You could read this frequently asked questions, but basically what you can see here is that one of the key answers here is that they don't just take the 2-quarter of decline definition that many of you had learned in 131. They look at a variety of things. The problem with that is that when they look at things, they typically don't note that it happened until long after. Some of you may have seen this chart before, but what this does is it tries to date when business cycles are happening. And what you can see here is that we used to have business cycles used to be rather short, meaning we'd have a recession every few years. It's really only until most of your lifetimes that we've had incredibly long periods of time where the economy is expanding. I mean, look at this. We have economies that are expanding 10 years. That's an incredibly long period of time. Really, the only time we get that after that is in the 1960s. Also a period of intense growth. But before that, a typical growth period was only happening about a year and a half. And you can see here then, if we look at the cycles, the business cycles that have happened since the end of World War II, that we've gone significantly longer between recessions, 5 to 6 years long. And if we look at, so look at this. We have here they send out these press releases of when they think a recession started or ended, and they typically don't come out with that until 9 months or almost a year later after the recession has started. It makes economists look bad because it makes it look like we're saying the obvious, but it goes to show you that the National Bureau of Economic Research does have a pretty significant amount of time that they put into trying to actually date when a recession happens. So will this be a recession? Technically, we're not going to know for a very long time. In January, as you saw, then it was pretty easy to make a bullish, meaning you thought that the stock market was going to go up. It wasn't hard to make that kind of prediction. Really didn't think that much about COVID-19. And if anything, everyone just thought things would just kind of slowly slow down. The only kind of point of concern was still, maybe the trade war between China would resume a little bit more. Maybe corporate earnings wouldn't be that great. Some people kept saying things like, if you're taking a bit more finance classes, there's this thing called the PE ratio, the price to earnings ratio. And some people were saying that was a little bit too high, in that maybe people were expecting too much, and that maybe the stock market would be hurt a little bit by that, but no one was really predicting that much of a big change. But that doesn't obviously, stay that way. It's not, this is a public health crisis. We could certainly say that. Really the debate right now, and what is sort of unknown, so I'm not saying this with any certainty, but what we don't know yet is whether this is a economic crisis. With the financial crisis back in 2007, 2008, it was a little bit easier to note that it was a crisis. And the reason why is because you had housing prices. Housing prices had increased. Everyone was flipping houses, so you could see that euphoria. Then something changed. Something that changed was the availability of individuals to get housing loans. And when that changed, the price of houses declined, and then the housing bubble burst. So again, the 2008 was not just a recession, it was a financial crisis. It was an economic crisis because there was an asset bubble that burst. It's really hard to say that right now because based on what we know right now, on what has happened, you can't really say there's a crisis yet. Now, as I get to the end of these slides, I do want to talk a little bit about where I think there might be a crisis and how this might be the thing that bursts the bubble that does exist. But for right now, we can't really say any bubble has burst just yet. But we do know with some level of certainty that there will be a recession. We just don't know. We don't know yet whether it's a crisis. So look at this. So I just took this simple chart. It just shows you now the extent of the crisis. So this dates back to the first trading day of 2020 to today. And since that point, markets have fallen about 34%, 34.85%. So quite a bit. If you invest in anything, you've lost about a third of its value. For one of the steepest declines really since the Great Depression. In this month of March has been the worst March since the Great Depression. So why do we think that there is going to be a recession? Let's work with that. Most of it's coming from the fact that basically the economy is shut down. The country is shut down. You've got lots of lost jobs because of the losses in the service industry, in the restaurant, the hospitality industries. You've got not only the loss in the GDP, but you've got the loss in the jobs and the income that comes with that. So no one is spending any money, even if you're allowed to go outside. And so then the Wall Street Journal, pretty notable financial publication, then surveys economists. And while most economists are thinking that the most optimistic is just saying that the recession might be an incredibly light recession, that maybe by the end of the calendar year that the economy would start to do well. Some people are saying that it could actually be worse than the 2007 to 2009 crisis, primarily because maybe kind of what my last slide would be of like, what if this causes some other bubble to burst? And also, too, as my last bullet point identifies here, we don't exactly know yet the scope of the pandemic in the United States, right? We're all doing this flattening the curve thing, and we're all kind of seeing where that all ends up. But we don't know whether we were successful or not. We certainly are not going to be as successful as South Korea was in flattening their curve, but maybe we'll be better than Italy. We don't know yet. And all this is changing quite rapidly, because if you look at the estimates even just 2 weeks ago, people were much more optimistic 2 weeks ago than they are today. So let's look at this here. These are from the survey that the Wall Street Journal did here. These are the most pessimistic to optimistic, or optimistic to pessimistic predictions of what the unemployment rate would be in each of the 3 quarters. So the year is divided into quarters. Quarters consist of 3 months. So quarter 2 would be starting here on April 1st. So it'd be April, May, and June. And then so on and so forth. So the most optimistic economists believe that essentially the unemployment rate would be unchanged at 4.5%. And that's not too different, I don't think, from what the unemployment rate is today. Yeah, 3.5%. So basically, the most optimistic say it'll go up to 4.5%. But even if the unemployment rate was 4.5%, we'd still be at full employment here in the United States. The baseline, so it'd mean like the average economist would say that we'd be in about the 5% range. That would still be about that'd still be about full employment. That wouldn't be anything too worrisome. But then you get the most pessimistic. And the pessimistic then say that, yes, there's a downturn right now, but then people continue to not spend the money. driving the unemployment rate then to as high as 7.4% in quarter four of 2020. To put that in perspective, at its highest point in the economic crisis of 2008, 2009, the unemployment rate reached about 10%. So the unemployment rate would still be less than what it was 10 years ago, but it would still be historically rather high. So this is just unemployment. Then we've got GDP growth. Again, optimistic to pessimistic. So the most pessimistic individuals believe that in quarter two it would fall by 10% production, then production would fall by 3.8%, and then production would fall by negative 0.5%. So that's your most pessimistic. Optimistic say that we have a really bad second quarter, but then things actually almost resume back to what they were. And then you've got your middle ground. So again, when we look at these forecasts, you see things all over the board, and those are professional economists, and even myself, a PhD economist, I'm not exactly sure what I would say is going to happen next week, let alone next month or next quarter. So making all these predictions is rather difficult. No matter who you believe, though, things are going to be bad, at least in the second quarter. Really, what makes you optimistic or pessimistic depends on how you think the rest of the year is going to be, how your third quarter and your fourth quarter is going to be. And that just might make sense because, quarter one, February and March were pretty strong. March is a loss, and that loss in March is just going to continue over into April, May, and you're only going to slowly ramp up by June, even in the best case scenario. In the worst case scenario, it lingers. Things continue to be bad. So the question then becomes, what do we have? Do we have a recession or do we have a depression? Again, the optimistic individuals believe we get through the health crisis. We find a cure, or I know nothing about medicine, so don't. Whatever. We find a way to get through the health crisis. We get a minor recession, and then we just move on. But again, the pessimistic believe we would be incredibly lucky and fortunate just to get out of this, just a minor recession. And that what we then need to do as policymakers and bankers, which I'll talk about here in the later slides here, is we need to take a lot of action to try to make it just a recession rather than a depression. But there's another way to think about this outside of an economic crisis, and that would be this term here. Rara avis interis necroque simila signo. It's Latin, and it dates back to Roman times when there was this idea that no one had ever seen a black swan, that all swans were white. And so individuals would say things like, oh, it's so rare. In this case, what that for those of you who aren't Catholic, like myself, and know a fair amount of Latin, that would basically mean that the bird is rare. The bird is so rare upon the earth as a black swan. So if you never encounter it, then you would use the term black swan to say that something that possibly could happen, like is possible but is not probable, and there's very little chance that it would happen. Not for nothing, but I don't think I've ever seen a black swan. But that term becomes popular in 2001. Which, for those of you who study finance, you would have heard this term before. But black swan becomes a financial term. And basically what it means in the fields of finance is that it's a rare, unpredictable event. But if that rare and unpredictable event happens, it has incredibly serious and unavoidable effects on the rest of the economy. So if you click on this link, you can read how this applies to COVID 2019. It's a really interesting article. I'd encourage you to read it. I think it's pretty interesting. But if you're into that kind of thing, I would encourage you to look at that term. What it basically says here is that, where is this capital from? Sequoia Capital is a large hedge fund, where some people like Sequoia Capital say it's a black swan event and we don't really need to worry about it. Others say, I'm not really sure that this is a black swan because we kind of did know that there are these pandemics, right? We did have the Spanish flu, we did have Ebola, we did have SARS, we did have swine flu. We've had big diseases before. It's just that this one's actually particularly bad. So some people, instead of calling it a black swan, call it a gray rhino, which I actually kind of like this term because it's like a rhinoceros running at you. It's obvious, it's visible, and if it hits you, it's totally gonna like really hurt you. And you basically know if it's running at you, you are gonna get hurt. So the probability is not that it's rare and unexpected. We know that we will get sick, right? I mean, not that the flu is a pandemic, but flus also kill. Not that COVID-19 is the same. COVID-19 is the same as the flu. It is not. COVID-19 is more deadly. It's not the same thing. Though what we are saying though is that because it is more deadly and because it is spreading even at the same time as the flu and because it attacks your body in a slightly different way, the ramifications for it on the economy are much different than just the flu. So where do we go with this? We basically then have to try to find some sort of solution. Whether it's a black swan or a gray rhino, we need some sort of way to think about this. And if you use the word black swan too often, it's just kind of it gets you out of really trying to think through the problem, because then it just makes it seem like, like shit happens, it makes it sound like you could have done nothing to have stopped it or that there is no solution. You just have to let time take its course. But I'm not convinced that that's the idea either. Many economists agree that this is basically what is needed is a 3-part solution. We need a public health part to the solution. I'm not going to comment it on a slide because, again, I am not a public health expert. So that would be things like developing a vaccine, or that would be things like, developing a better mask, or developing more masks, or having more respirators, or having more hospitals, or, I don't know all the other things, but I rely on someone smarter than me to do that part. But the part I can talk about would be the fiscal side of this and the monetary side of this. So let's start with the fiscal side of this. What fiscal policy consists of is it consists of the federal government, the national government spending money, or giving people money and encouraging them to spend it. I was going to start to type this slide and you kind of see I stopped because as of today, March 23rd, we don't exactly know what's going to happen here. Let's just look at this in real time. You can talk about this in your reflection paper if you want to. But essentially, we don't have any agreement. I think Trump was saying he wants to spend like somewhere between $1 to $2 trillion to stimulate the economy. I think every individual would get about $3,000. The idea would be you get this money and then you spend it. That's what Republicans want. Democrats want more paid leave, like sick time. They also want more unemployment insurance. So those would all be things that Obviously, if you lose your job and your unemployment runs out or it's not that generous, then you have no money to spend. And that doesn't stimulate the economy. Then I think, as I understand it, and I'm no politician, as I understand it, part of the debate as well is how much money is going to be given to companies to help them survive, or do they deserve to keep living? So one example would be like the airlines. The airlines don't have a lot of cash; they're going to go bankrupt unless the federal government spends a lot of money to support them. Republicans want to give them that money. I'm not sure you could say Democrats don't want them to get the money, but I think if they give them the money, they want something for it back in return. Which, right, I guess that's probably the part of politics, right? Is that you give something and then you get something in return. You kind of see this kind of debate here. Fiscal policy is very messy. It's always very messy. It's always very messy. Because you're dealing with politicians and them needing to act quickly, and they almost never do. It happened in 2008, 2009. Actually, I can show you this here pretty quickly here. Wow, look at all this cool stuff I should watch. I don't really know how to type this in here. It's 53 seconds. Oh, wait, this is the one where they actually did do their job. Sorry. Let me find the one where they didn't do their job. Just give me a second here. Well, I guess actually let's just look at this here. This is only 3 days ago, so this actually might be a better description of it than I would provide you. Sorry, let me just do this here really quick. Again, my apologies for using YouTube a lot here. I'm not trying to have YouTube replace me. It's just that there's a lot going on right here, right now, and I can only be an expert on some things. I can't be an expert on everything. Let's just look at this short news report, which I'm going to be watching at the same time as you're watching it, just to kind of see what the Senate, I guess, is proposing as their end of fiscal policy. Sorry, we have to wait for the ad. Oh, they're really making us watch this whole commercial here.
Today, the Dow tumbled more than 900 points to end Wall Street's worst week since 2008.
So this would be Friday.
Reportedly on pace for its worst month since 1931. And we're only starting to learn what this pandemic means for the workforce. Chris Van Cleve joins us now. Chris, these are pretty ominous signs for workers.
And Nora, with every passing minute, more Americans are losing their jobs. Economists are now talking about record levels of unemployment as businesses shut down. They say we could see the number of laid off workers hit between 2 and 3 million this week. The news of her layoff came as a total surprise to eye doctor Drosti Makwana.
I never thought at 33 I'd be filing for unemployment.
But as 5 of her eye clinic's 6 branches close down, she finds herself applying for unemployment benefits.
So I had to resubmit everything today. It crashed like 3 times in the process, so it's tough.
Sheila Red drives a school bus in Illinois. But schools are closed, so she's out of a job and not sure unemployment will be enough.
We already only just get paid weekly, but now to go from weekly to nothing at all, that was my biggest fear.
The Senate is racing to pass a $1 trillion economic stimulus bill. The Republican-crafted package would send money directly to Americans based on income and family size, up to $1,200 per person and $2,400 per couple. It would also provide loans to small businesses and big industries like airlines, who have asked for nearly $60 billion in aid. United told employees today if that help doesn't come by the end of the month, it will have to slash its payroll by up to 60%. And these striking pictures. Delta has started parking hundreds of its airplanes. Laura Einstelter is an airline pilot who was furloughed after 9/11.
It's been shocking every day. To some degree, it almost feels like electrocution every other day because it's news, and forever changing situations.
There are some bright spots. Walmart says it's going to add 150,000 workers. Domino's says it's going to add 10,000. And JP Morgan Chase is offering bonuses to its tellers for staying on the job, or a $1,000 bonus for staying at work.
Wow, Chris, thank you.
Okay, so see what you see there is that the Senate, at that point, that was on Friday, was basically going to give a lot of money to the airlines. And the idea there is that you then stop the airlines from putting more people on unemployment. And as I understand it, the Senate bill wasn't going to offer much more in unemployment insurance. So unemployment lasts 26 weeks. It wasn't going to offer significantly more for that. It wasn't going to do anything for individuals who need paid time off. And I think that's what the Democrats are rejecting, is why give so much money to the airlines if you're not giving money to regular people. What I'm saying here, I'm not trying to be political about what I'm saying here. I'm just saying that is the nature of the debate between the two. Now, let's talk about something I can talk about a little bit more with a little bit more expertise here, and that would be monetary policy. The monetary policy has been quick. It's generally quicker than fiscal policy because you have far fewer individuals, and we're all economists that are engaged in this. We all have varying political opinions, but our response to the data is a little bit more uniform. And so there's basically this belief that this graph is coming from someone else. I stole it. The belief here, and you're seeing this over the course of just a few 2 weeks here, 16 days, a little over 2 weeks, is you're seeing banks, both United States and the Bank of England, European Central Bank, Bank of Japan, all reducing interest rates. And again, what they're doing there is they're increasing the money supply, reducing the interest rates, so as a way to encourage people to borrow money. Like, you'd be basically saying, why would you borrow money to buy a car right now? And the only reason you could give yourself as a reason for buying a car right now would be, I could get the car with a 0% interest, right? Or I could buy a house with very little interest, or I could start a business with very little interest. And what's a little bit more worrisome about this monetary policy, which echoes a little bit what happened in 2008, 2009, is you're also seeing not only a reduction in interest rates, which would be a typical way of responding to a recession, but you're also seeing here increasing in asset purchases. So asset purchases meaning that the central bank in these countries are buying bonds directly. That gets worrisome because what that means is that institutions and individuals are not buying the bonds. And so if they're not buying the bonds, then the bank has to buy the bonds. Because if the bank doesn't buy the bonds, then the economy collapses because there's no liquidity anymore. So that's obviously worrisome here, is that everyone's basically hoarding cash. No one is buying bonds, but people still need to borrow money. So the central bank is becoming the lender of last resort, and it is basically buying the bonds, lending out the money. This stops on the 19th, this chart I stole, because then what the big news that came out last night, so it would be on the 22nd, would be the Federal Reserve also intervening once again. Even though the stock market was down on the 23rd, it was up for a little bit, at least in the pre-market hours, and it was up because the Federal Reserve was going to start lending more money. My thing's not. Oh yeah, here it is. They're going to buy back an unlimited amount of government debt. So basically, the Federal Reserve on Sunday said, no matter how much money the federal government needs, we will lend all the money that it needs. pause on that for just a little bit. I mean, really the thing that controls the levels of U.S. government debt right now is that people, institutions have to buy that debt. You're not going to see that as of right now because the central bank will buy it. What it does is it explodes the size of the balance sheet. Let's just look at what that looks like here. I'm not. I don't want to look at anything too. I'm going to look at a kind of a classic picture here. So, for those of you with even just a basic accounting understanding here, what you would see is that this is going back to before the 2008-2009 crisis. You don't see a lot of different colors here. You see basically a lot of dark blue. That would mean that the Federal Reserve, the central bank in the United States, owned government debt, but that was the only thing it owned. What made the financial crisis of 2008-2009 different was this now explosion of colors. And it's that explosion of colors that gets scary because it means that they're buying MBS, that's mortgage-backed securities. Other securities, that means other kinds of government debt. Maiden lane, again, just buying different things. And so Ben Bernanke, as chair of the Federal Reserve at that point, had to be brave enough to start expanding what the Federal Reserve could buy. Janet Yellen basically had to continue that, but you can see here that at the very end of 2018, she started a campaign, and you can see it very small here, but she started a campaign to start to reduce all these different colors. Obviously, that's now all been destroyed and reversed by the current generation. Okay, so let's go back to this. Sorry, let me just pause this 1 second. Okay, so what you're seeing here mostly, and this would be the biggest critique of economists here, would be that you're seeing a lot of monetary policy movement and monetary policy attempts to fix the economy, but you're not really seeing meaningful fiscal policy. I wouldn't say that monetary policy has been completely exhausted, but we're reaching the limits of what monetary policy can do. Okay, so now let's look at this from the perspective of what's going on in Hawaii, just to kind of make this a little bit more relevant to what's going on here. No matter how you look at this for Hawaii, Hawaii is going to be incredibly hard hit. And primarily because as an economy, we shifted and kind of went all in to being a leisure and hospitality economy, even more so than what it was in the 90s. So what that meant is that, this past decade's been great. And this past decade's been great because everyone's come to visit here with all the money that they've got. But what that means now is that the fall is quite significant as well. You start to see this here. So this is the data this is the unemployment daily claims. You see this fall off here, but that's because the website crashed. And I'm not trying to laugh, but I mean, it makes it look like the data is better, but it's not. So what you're seeing in this is this phenomenal increase in, and this all actually predates as well. If you look at the dates here, this is predating the restaurants closing down. It's obviously predating the stay-at-home orders that Oahu and now the entire state has. So this is only going to go up in terms of what the unemployment numbers are. Unemployment would count as a fiscal policy, and unemployment, the way that unemployment is funded is that your employer pays a portion of your salary into an insurance pool. And when something bad happens, like you go on unemployment, that your employer basically pays the money needed to pay your wages on unemployment. I could make you a separate lecture about this if you're curious. about how to actually apply for unemployment insurance. I've helped a few students apply for it at this point, but no one's getting rich off of unemployment. It pays you about up to it pays at least, if I'm not mistaken, $70 a week, but it'll pay you no more than $400 a week. That's pre-tax. You do get taxed on that. But if you can't earn more than $400 or $500 a week, you're going to maybe be able to pay the bills, and that's about it. And your employer will basically pay that to the state through their insurance policy, and the state will pay you. So the only other thing that is a little bit interesting, we talked about this very briefly, was there's this whole idea that given how much the stock market is falling and how that's kind of contributing to this hysteria that's going on in the economy, is that maybe what we need to do is we need to just stop people being able to look at how fast the stock market is falling. So there's this debate about whether we should close the market entirely, or maybe what we should do is just close the trading floor. There's a pretty big difference between the two. If you just so when you look at a trading floor and you see people trading at these different panels, at these different booths, obviously with COVID-19, there might be some attempt to stop that from happening, because you wouldn't want people to be getting that close to each other and trying to, and getting each other sick. But the computers can do the trading. People could do the trading electronically with each other. You would still see how the market is trading in value over time. The only other thing you could do is close the entire floor entirely. But also, too, you can't just there's some people that say you just can't do everything electronically. So those people actually can't be replaced to some extent, can't be replaced by computers, because they engage in what's called a D order. They do D quotes, which basically means that if things are trading outside of what the parameters, what the computer algorithms and what the parameters say, and this especially happens towards the end of the day when things are so volatile and things are moving so much, that really the only thing you could do is you need physical traders to do the trading. And they actually do quite a bit of volume. And so what those physical traders do is they basically smooth things out. They smooth out the volatility so that you get a trading day that closes near where it kind of opens. So this week, the week of March 23rd, is the first week that we're going all electronic. So you would be bound to see a bit more volatility this week. Now, after that, so that's just closing the trading floor. What if we were to actually close the market? That's pretty difficult. And that's what my last two bullet points identify here. On one level, traders, you wouldn't think it, or maybe you would, but they are incredibly patriotic. They see themselves quite often as soldiers in a financial war. And even in 9/11 and other, even like things like the Spanish flu, that people still traded. So the idea that you would close the trading floor is one thing, but to close the market would mean that you're, hurting America, that you're, it's like being anti-grandpa. It's just seen as like something you just don't do. That the stock market is as old as the country. To do that would mean like you're giving up, that you're just losing the war. And there's all the other things that we kind of talked about as well, is that if you close the market, people don't get very stable information. So it might make it look good that you're saying that things are not trading very much and that things are not falling as much, but it actually might make things worse, because then when the markets do reopen, things get very, very bad. What I want to talk about in this last slide, though, would be why the Federal Reserve is doing what it's doing now, where it's buying other things. The thing that it announced yesterday, March 22nd, is that it's actually going to start buying corporate bonds. And it actually is going to also start to buy ETFs, meaning exchange traded funds. This is pretty significant, because what that signifies is that people and institutions are not buying enough things, and that, again, if you don't find any buyers of corporate investment grade bonds and stocks, that the entire market could collapse. And you're starting to see that if the economy obviously is slowing down right now, and that if it grinds to a halt and that firms can't find their money, that very good companies could see themselves going bankrupt. But what it also means is that good and maybe even just kind of middle performing companies that have accumulated a great deal of debt during this past decade to grow fast might also collapse. So that would be things like Uber or Lyft or any number of firms that kind of emerged in this past decade that borrowed a lot of money to grow quickly, that they might also collapse because they're not going to be able to pay off all that debt that they acquired as their model completely goes out. And what it's requiring is that the Federal Reserve intervene to get us around that issue. Okay, so that gives us a overview of, as I see it, the financial problems that have existed over the past 2 to 3 weeks. I will try to update this video next week with some additional information that's kind of accumulated over the past week. But if you want to take this as the end point for the lecture, I know it's kind of quick what I did here, but if you want to take that as the information we have here and then just apply it to the class material, you can go with that. So anything I provide beyond this would just be extra knowledge for yourself.